Thanks for staying with us in the second quarterly roundup. Joining me now is Saul Miller from Truffle Asset Management. Saul is one of the 4 portfolio managers on the Nedgroup Investments Balanced Fund. Thanks for coming, Saul.
Thanks for having me.
To dive right in, performance of the Balanced Fund has been quite strong, particularly over 1 year. Maybe just a comment quickly on what has been driving performance.
Sure. So one of the key drivers over the last, particularly over the last 6 months, has been our foreign equity. Most of our sectors and shares have done particularly well, particularly sectors like defense, which is not surprising given what we're seeing in terms of defense spend in Europe. So a lot of this is actually European defense shares. We've had quite an exposure to some of the European financials that are just incredibly cheap, paying out very high dividend yields and doing a lot of share buybacks. And then there's quite a few stock-specific companies, which I won't go into here. Naspers and Prosus has done quite well for us, and in addition to that, we've finally seen a bit of a recovery in PGM prices, particularly platinum has really risen finally, and that's also done nicely for us. We've got a reasonable exposure to the PGM miners. So those really some of the key drivers of the performance in the last particularly in the last 3 months and the last 6 months.
Yeah, if I look at the sort of quarterly attribution and I compare it to the first quarter, it's really a continuation of what's been doing well for you.
That's correct. I'd say, yeah, platinum or PGM has probably picked up a bit more in the second quarter versus the first one, but the European themes and the global equity has very much just been a continuation.
On the topic of themes, I'm keen to get into your thinking on the themes. Maybe just briefly what's been driving your overall outlook.
Sure. Well, there's obviously been a lot happening, particularly in the US. We've obviously got tariffs. There's still a lot of uncertainty as to where tariffs are going to settle and what their impact is going to be. There are a lot of geopolitical tensions outside of that as well. Given all of that and given how well markets have done, we'd say markets are a little bit complacent at the moment. So that is certainly something that worries us in terms of portfolio construction. We're trying to actually be a little bit more defensive, ensure we invest in sectors and shares that have got some robustness to a potential slowdown in the global economy, which wouldn't be surprising if we saw that at this stage. In particular, the US could slow a little bit in H2 as some of these tariffs come through. Presumably they are going to come through in some shape or form. Just the quantum is yet to be seen, but we could see an extra 2% being added to inflation, which obviously hit consumers. So it's a little bit of a headwind for the US. Probably more importantly is really talking a little bit about debt, which we can maybe do a little bit later, but obviously that's a worry for the world. That talks a little bit to continued dollar devaluation, which also has ramifications for various sectors. I think China is starting to stabilize a little bit, so they've still got headwinds in terms of property, but it's obviously becoming a smaller part of the economy. Property prices, they're not declining as much. We're seeing quite, if we look at the last half year, we've seen some major breakthroughs in technology from China, which is obviously very good for productivity growth in China. So I think that's positive. Certainly made us more positive on China if I sort of look back over half a year ago. In Europe, we're seeing a bit of a recovery, particularly on the fixed investment side, and quite a bit of that coming from defense spending, given that NATO now has to spend a lot more. That obviously has ramifications for certain sectors in Europe. And then in SA, it's a little bit more of the same. We still have a reasonable amount of political uncertainty, whether it's the GNU or whether it's succession in the ANC. Those sort of issues stay with us. We still have issues around fixed capital, which is inadequate, but we are seeing some positives in terms of the terms of trade, which is at least a bit of a short-term tailwind for SA. And valuation is usually one of the overriding themes as to why we often have a reasonable exposure here, as things are usually quite, or there are certainly sectors that offer a lot of value.
That's quite a bit. So let's dig into some of those, I think, in a bit more detail. This quarter started off with a bang with Donald Trump and his Liberation Day tariffs. As you mentioned, that hasn't gone away. It seems to change from day to day, if not week to week. The US remains a key driver of global markets. How has this escalating geopolitical tensions and an increasingly inward-looking US foreign policy, how has that contributed to global markets, and how does that inform your view on the US?
Okay. Well, It probably should have weighed more on markets than it has, and that really goes to my point that I made earlier, that markets seem to be a bit complacent, just given the geopolitical stresses and pressures that we're seeing. I mean, US foreign policy is not particularly good it's not good globally to have tariffs. It's not good for the US. I mean, we don't have to rehash why tariffs are bad. Generally, I mean, there might be specific circumstances where they're good, but broad-based tariffs are generally not a good thing. There are attacks on consumers, there are attacks on companies. We'll have to see who bears the brunt of that going forward. Some of the US's own policies, without having a discussion as to, what they're doing internally, but, if we look at attacks on the judiciary, on institutions of higher learning, what we're seeing in healthcare, none of these things are particularly conducive to a healthy investment environment. Now, none of it may impact them in the short term, but they are long-term concerns. Could all be reversed at some stage, but certainly, if they're not, I'd say they certainly weigh on the US. So you're generally seeing, whether it's internal or external policies, they're not great for the US, and any external policies are probably heightening geopolitical risks, which is not discounted into the market, which is something that makes us a little bit worried about markets. However, having said that, we're certainly finding a lot of opportunities in various sectors and shares where we get a lot of value, and you get shares and sectors with fairly defensive earnings that will be reasonably immune to some of the economic pressures that we might get. So we still have a reasonable exposure to equity in our funds as a result of various opportunities. But if you just look at the indices as a whole, there's probably a bit of overvaluation there, particularly from the US.
I think more lately, Donald Trump, the latest sort of big news item has been his big beautiful bill, which has been a common theme, I think, today with some of in our other chats as well. One of the issues that could potentially escalate is the fiscal challenges faced by the US. Maybe can we go into that for a bit?
Sure. So the fiscal deficit remains very elevated. The big beautiful bill will keep it elevated at kind of more than double what it's been, over the last odd 50 years. It's a level that is not sustainable. We're seeing debt levels rising. As a result, if you look at any forecasts of US debt to GDP, we're going to be far in excess of the previous high in World War II. And unlike World War II, there's not military spending that you can cut back on. We don't have that lever to cut. If we cut spending now, it's obviously going to hit economic growth. And at some stage, they are going to have to hike taxes or cut spending or do both of those. And that will hit growth. It's just when. We don't know when that happens, but that's certainly something that weighs on the US and is a worry. It's also difficult to inflate your way out of this. There's not an appetite from voters to stomach any inflation. And the Fed certainly doesn't, want to, they don't want to encourage any inflation. They'll probably be quite aggressive. So some kind of fiscal consolidation at some stage, barring something that causes huge GDP growth. It's not clear that we get that. There's pain at some stage. The difficulty is the timing, but it's certainly something that weighs a bit on the US. It's something that we would worry about.
So potentially an issue, for down the road, but not sort of right now and here. But I think if we look at more the short term, I think something that we can observe is probably, if we look at the dollar already year to date, we've seen some weakening, but overall it still looks a bit expensive. Would you agree?
I would agree that the dollar looks reasonably expensive. There's a chart that we provide of the trade-weighted dollar in real terms, and you can see it's, from the chart, it is still fairly elevated. The reasons why we would worry about the dollar is obviously, given that you've got a lot more debt coming, that means more supply of bonds, given the geopolitical pressures that we're seeing, and given concerns around rising US debt levels, that means less demand for US bonds as well. So these things are not particularly positive for long interest rates or for the dollar. So these things probably keep weighing on the dollar, and there's certainly room for the dollar to depreciate further. And that's obviously could be, at least at the margin, it could be beneficial for things like commodities and for EM, essentially assets that are not denominated in dollars. So at the margin, you could get a bit of a benefit from that. Certain companies also obviously may benefit from that as well.
I think that ties into that lift in asset prices that we're seeing, sort of, non-US assets. As you mentioned, US policies broadly negative, and one of the areas you found good opportunities in, you alluded to this earlier, is Europe. Your thoughts on Europe as a whole?
We are seeing finally a bit of an improvement in growth, in expectations for GDP growth in Europe. It's particularly coming from fixed investments. Quite a bit of that would be from investment in defense, and that's obviously related to this requirement for NATO to up their defense budgets, and these are very long multi-year projects. So the companies that supply defense are obviously going to have fairly long periods of substantial earnings growth. So that's a particularly interesting area for us. Some of them have really done well. It's obviously quite an in vogue theme, so some of them have got a bit expensive. We've been reduced exposure, but we still maintain a sizable exposure to defense overall. There are quite a number of companies in Europe with very defensive earning streams. You've got the likes of Kony, which is a lift company. It essentially makes most of its earnings and revenue are annuity based from the servicing of lifts. So it's very defensive to any kind of economic downturn. You've got companies in coffee like JDE Peet. Coffee demand is very, very stable. Even in a downturn, people want to consume coffee. And given that these companies have suffered from very high coffee prices, which is an input, as that comes down, it obviously means more profit for them. So there's lots of examples of companies that are not necessarily going to be under pressure should we see a bit of, should we see the world economy come under a bit of pressure. You've also got some cheap valuation opportunities in Europe. If you look at the banks, quite a number of European banks are still trading at or below book value, yet most of them are covering their cost of capital. They're providing particularly generous dividend yields, and they're doing share buybacks. So we think that's also a great opportunity. And obviously, you've got parts of Europe that are actually growing reasonably, like the likes of Greece. And in Greece, you have banks that obviously benefit from that growth to an extent.
Could you perhaps then also spotlight some of the other companies that you're finding in Europe? I mean, the bank sounds it's a sort of similar, it's a story to SA, but any of the other areas that you've liked in Europe?
So you've got companies like Airbus. When I spoke about companies with defensive earning streams, Airbus is an example of a company with very specific factors that are going to provide it with quite substantial earnings growth over the next few years. Airbus essentially has an order book which they have to deliver into. They have a very long order book, and it's not unsurprising given what's happened to Boeing. So you've essentially got a fairly high conviction earning stream coming out of this company for many years, and that's just another example of a company that won't really be impacted by economic circumstances. And you can see on the slide there are quite a number of companies here, and really on this slide we're really mostly putting in defense companies. Airbus has a fairly small defense component. It's mostly civil aviation. But if you look at some of these other companies, they're fairly well spread across the defense space. So you've got the likes of a Babcock that would be very involved in ships and submarines, which are obviously going to be huge growth areas. You've got the likes of Leonardo involved in air, in helicopters, in radar. And we could go on as the list moves on. Some of them are more involved in consulting, but essentially all these companies should do well in this environment. I mean, I put at the bottom of the list Renk, which does drivetrains for tanks. You can see that is particularly expensive. It's in excess of a 40 PE, and that's actually one where we actually reduced some of our exposure just given how well it's done. So the valuations in general for these shares, they're not particularly low, but we have many years of earnings, given that we're seeing a generational change in defense spend. So it's really important to bear that in mind when you're looking at these valuations that might look a little bit elevated.
I think moving more eastward now, another big target of US policy, of course, has been China. I think the big emphasis of US policy largely has been to counter China, forcing companies to move away from that part of the world. The fund has been underweight China's exposure, but you do have some exposure. Has that changed at all? And, what's your views on China navigating through this period?
I'd say we're definitely more positive on China than we would have been half a year ago. Some things have been quite positive in China, so I think the attitudes towards technology has definitely improved, and we're seeing a lot of tech innovation coming through in China. If you look at this chart, which is sort of an innovation index relative to GDP per capita, you can see China stands out like a sore thumb. So they clearly innovate at levels which are similar to many of the first world countries, yet obviously got quite a low GDP per capita. So it sort of talks to an ability to have quite a bit of productivity growth going forward. So this should be particularly positive for China. The negatives still remain in terms of there's still quite low levels of consumer confidence. You've still got a fairly elevated property market. However, I mean, what you do have is you have property, which is a much smaller percentage of GDP. So although we might still see pressure on house prices, they're becoming less and less of a contributor. And I think that is certainly a positive, as in it's a smaller negative at least. The delta is positive. In terms of their exports to the US, I'm sure you've obviously seen and heard, they've obviously been reducing that over time and moving that elsewhere. And that's obviously been, that's also a positive for them. So they get less affected by tariffs. So on balance, I think things are looking a bit better for China. And we still have a modest exposure there. We obviously have it via the likes of Process through its exposure to Tencent. That's a fairly defensive revenue and earnings stream, so we like that. And then we have some smaller exposures to the likes of Tencent, Music, and Alibaba. Alibaba obviously being very, very cheap. So we do have a modest exposure to China, given some of these positive changes that we've seen.
And those companies you mentioned, obviously being quite sticky within their own ecosystems in China, of course.
Definitely.
I think bringing it back home now, on the margin, there does seem to be quite a bit of improvement, at least, that we're seeing in a lot of areas, lots of transport, logistics, load shedding is very much been reduced. Do you agree with that view? And, on the other side of that, what still concerns you about SA?
Okay, so we have seen some positive. We've seen load shedding sort itself out. We had a good outcome from the election last year. There still are, we obviously still have some huge risks that weigh on SA. And I mean, one of those is gross domestic fixed capital formation, which is incredibly low. It remains low. It's very low if we compare it to the rest of the world. You often look at it as a percentage of GDP. That still remains a concern, and we're not seeing any major traction yet. There's certainly ways to get that up. There could be some easy wins. We have yet to see that. We haven't seen it. That's a bit of a medium to long-term worry, as is the political situation that we find ourselves in. It's kind of very up and down. We still have risks around the GNU. We have risks around succession. So there still are some sizable question marks. I think on the positive side would probably be the terms of trade for SA. We've seen this massive ramping up of PGM prices, particularly through platinum. We've also seen gold much higher. So our commodity complex that we export is looking quite a bit better, and some of our imports in oil are a little bit lower. So everything's working in our favor. That is good for the rand when that happens. It's easier to cut rates. It's generally associated with a better economy. You also get more tax take. So on all fronts, that is something that is quite positive on the short term for us. And I mean, we are exposed to the PGM sector. So we like that. Yeah, we're quite positive on that aspect of SA. We like the short-term factors. There's a lot of work that needs to be done on the long-term factors in terms of politics and in terms of fixed capital formation. And obviously, we like valuations in SA. So valuations are reasonably compelling. If we look at bank valuations, you're getting very generous dividend yields. You should be getting some growth out of those. And then we've got quite a lot of companies in SA that are quite defensive. So their earnings are not dependent on the local economy or on the global economy for that matter. And we quite like those opportunities as well. We like the defensiveness that adds to the portfolio. And I mean, you can see in the slide here, we give an example of some of them. Anheuser-Busch is one. We spoke about a weaker dollar being something that we're likely to see. A lot of their debt is denominated in dollars. And they obviously have a lot of EM exposure, so they would do reasonably well out of that. They've also got company-specific factors like falling commodity prices that are still to filter into their cost base. That would be a benefit to them. You've got some companies like Capitec and Discovery. They've got specific growth factors driving them. In the case of Capitec, they still are small in certain markets. In the case of Discovery, there's their banking operation, which is only just turning positive. So obviously that's going through the J-curve. That'll certainly buoy their earnings. Some of their offshore divisions are doing particularly well. So very company-specific factors driving these. And I've spoken about Tencent and Process already, so I won't.
Yeah, I like the fact that they are less economically sensitive, so you can still drive long-term capital growth within the portfolio despite what the economy is doing.
Correct.
Which is great for investors. I think to tie it back all, can you maybe take us through the portfolio, what's informing portfolio construction? I had a peek at the sort of asset allocation and looking quite healthy from a risk asset exposure. Would you say that's right? That sort of informs your view going into the second half of the year?
Correct. I mean, so we obviously said we think there's a bit of complacency around markets overall, and we're looking at market indices, but within that we are seeing a lot of opportunities that I've obviously spoken about, whether it's industries or whether it's companies with earning streams that are not linked to global economic growth or SA growth. So we're finding a lot of those, we're finding opportunities that are just particularly cheap. In other words, they're pricing in any kind of negative economic scenario, and that's why you see a reasonably healthy level of risk assets in the portfolio. We're seeing a lot of opportunity offshore, so you see a very nice balance between offshore and domestic as well. One of the things I mentioned was around US debt and this concern around rising US debt levels. We think that weighs on US bond rates over time. Of course, if you had to have a major slowdown, they would come down, but really barring that, there's a lot of pressure on US bond yields to remain higher for longer. In addition to that, we've actually seen SA yields come down quite dramatically. So the gap between SA yields and the US yields have really compressed. So on both of those metrics, we don't really want to own US duration or SA duration. So we've actually been reducing our SA duration into the strength in bonds that we've seen in these declines in SA yields. Duration is particularly low, and we've generally preferred equities, and that's how the portfolio is currently structured.
And I think we've seen the benefits of being a nimble and agile asset manager, where you've been able to move in and out of these asset classes quite quickly while still maintaining your views. We've seen that in the return stream of the fund, so it's stood our clients in a really good stead to be invested in the Balanced Fund. On that note, we'll end it there. We thank you so much for your time and your insights, all much appreciated.
Thank you.